Well, the rules are very easy. Email your questions through. strictlymoney@cnbc.com is the email address. Our guests here in the studio are going to be answering those questions. And today we're joined by Max King, an investment strategist at Investec Asset Management. And also still with us is Alpesh Patel, principal at Profinium Partners. Max, welcome. A number of emailers have already been writing through, and let me just take those questions just from an end and get stuck in there. A viewer writes in and says, the Chinese economy has improved dramatically in this recession. Does it mean that they're recession-proof, or is the recession confined to Western countries only? And as you just got back from Asia, from India, not China, but Alpesh, what do you think? Is China recession-proof?
There's a hell of a lot of things that ginseng can do, but making an economy recession-proof is not one of them, sadly. Yes, industrial production was up year-on-year 14%, figures just announced. Their biggest concern is in terms of inflation, overheating, and a bubble bursting, whether it's a stock market bubble or a property bubble. So it's certainly not recession-proof, but you're absolutely right. When you look at growth rates hitting 10% per annum, if you're worried about short-term dips, and we are with China worried about short-term dips, then you need to elongate your time frame of investment. And the best thing to do is look at a 3 to 5 year time frame, because if you do get a sharp dip in the next month, 2 months, 6 months, at least over a 3 to 5 year base, you will still be significantly outperforming given those underlying growth rates.
Max?
Well, we mustn't be overly focused on China. There's a good story in emerging markets right around the world. Higher growth, good valuations and outperforming markets. China has got some of the highest growth rates in the world. That won't continue. Inevitably, trees don't grow to the sky, and in due course, Chinese growth will slow down. But throughout the emerging market world, we continue to see pretty good opportunities, and that means, for example, Southeast Asia has been one of the best performing market areas in the world in the year to date, as have the peripheral economies of Latin America.
So you say don't ignore all the others and only
If you go stock specific with a specific company, you're going to have greater risk. If you go right at the macro level, look at commodities, and your view is we're going to continue getting growth despite dips in the short term, then on the commodities basis, not just oil, but I'm talking about soft commodities as well, grains and so forth. You've seen some of the phenomenal growth in those, which links into the China story and the India story, of course. People are going to continue eating, and they want to eat more and eat high quality foods. Then you can mitigate your risk by, again, elongating your time frame and looking at the slightly macro level, and just look at it as a funnel. The more stock specific you become, the higher risk you're going to take. So if you ask me specifically about oil, yes, the story about global growth isn't going to go away. I don't think, as we discussed earlier, there's going to be a double dip recession. Therefore, you're going to continue getting buoyancy as a generalization for oil, not a problem. But I think the commodity story as a whole gives you a good risk-reward balance, because you're going to mitigate that risk by diversifying.
And how would you play that commodity story?
Exchange-traded funds for retail clients, the people who are emailing in, it's going to be the easiest way for them to access them. And ETFs give you liquidity, low cost, and they'll track not just specific commodities. So if you particularly have an interest in wheat or corn, but also you'll have a commodity-based index, and that's giving you a play on the Far Eastern markets without necessarily being tapped into their stock markets, but more into what the population, the demographics are suggesting will continue growing, even if the stock markets don't boom.